Thank you so much. Thank you, Grega.
Thank you, Grega.
Bye-bye.
All right. Thank you, Steve. Are you starting to get the hang of Elliot now, Steve? All right. So we have Brent Johnson with us, guys, and you know what a great segue. You're talking about precious metals, and Brent has a fund, and I'm going to make him the presenter now. Looking forward to speaking with Brent. Okay, Brent, I'm passing you the baton, so I'm looking forward to hearing your voice, and I'm not sure you have anything you want to show on a screen share. If not, I'll take the screen back, but it looks like you do.
Yeah, can you hear me okay?
Can hear you fine, Brent.
Okay, great.
Very nice to meet you.
Yeah, great to be here. Appreciate you having me on.
And also a very good time to be talking about precious metals. And before we start talking about the markets, I know what you're doing now. I'm always interested in what people's entree to the business was.
Yeah.
Can you take us back and tell us how you ended up at point B? What was it at point A that got you into the industry and had you gravitate towards the PMs?
Yeah, sure. So I worked at a firm called Donaldson, Lufkin and Jenrette starting in the late 90s.
Okay.
And went through their training program on Wall Street for their high net worth group or their private bank, however you want to label it. Shortly after I started with them in New York, I moved to their office in San Francisco. And shortly after arriving in San Francisco, Credit Suisse bought Donaldson, Lufkin and Jenrette. So I spent 10 years with Credit Suisse in the San Francisco office.
Nice.
And overseeing clients for the firm, high net worth clients from the Bay Area. And I could make this a very long story, but I'll make it a short one. Is that in 2007 I had a meeting which really opened my eyes, and that was this young couple had sold their video game business for $30 million, and I met with them, and we kind of hit it off on a personal level, and then we kind of got around to their talking about their finances, and I invited them to come into our office in San Francisco, and I said, you can meet the whole team. You can meet the chief investment officer and our head of equities and our head of fixed income. And so we did that. We invited them in, and we had this beautiful office overlooking San Francisco Bay, and I ushered them in there, and we had all these managing directors there that I thought were just going to wow them. And this young couple proceeded to very politely just tear them apart with questions that the managing directors couldn't answer. And about halfway through the meeting, I realized this wasn't quite going the way that I thought it was going to go. But the managing directors were just so clueless to their own, BS, for lack of a better word, that they didn't even realize it. So, the meeting wraps up, I walk the couple to the elevator and they leave, and we agree to keep in touch and stuff. But I knew that they were not impressed with our team. And I walked back into the conference room to kind of break it down and kind of ask them, what happened, why weren't they able to answer these questions? And they were in there laughing. They said, this young couple, they made a bunch of money, they think they know everything, they don't know anything. And I left that meeting just thinking this isn't the way it should be. You couldn't even answer their questions, but you're the ones that thinking that they're the ones that are dumb. And that was a real eye opener for me. And in that meeting, this couple had proceeded to ask questions like, talk to us about the derivatives on your balance sheet.
Wow.
What's the national debt? Are you worried about the national debt? What's the real rate of inflation versus the stated rate of inflation? And they weren't really that hard of questions, but they were, I guess, obscure enough that, these guys just kind of didn't think they were important. And so I went back.
Maybe that's a testament to those people in those positions.
Yeah.
It's not what you know, it's who you know.
Yeah, right. And so I went back to my desk and I literally got out a piece of white, printer paper basically, and a pencil. And I went onto Google and I looked up the national debt and I wrote it out longhand. And I looked up how much our tax revenues were. I wrote all these numbers out longhand. I quickly realized, you hear these numbers and you don't really think about them, but you write them down and you see how many zeros there are, and you just realize that it's not going to end well. And I wasn't smart enough at the time to to figure out that it meant that the banks were all going to crash, the following year. But I was smart enough to realize that it wasn't going to end the way everybody else thought it was going to end. And so, that was kind of the beginning of the end for me at Credit Suisse. And so when we went through the crisis in 2008 and 2009, again, I'm not going to sit here and say that I called it or that I, profited from it, but I kind of understood what was happening. And I guess I felt like I understood it a little bit better than everybody else around me. And once we got through it and we were kind of coming out of it, I, went back into the same, chief investment officer, the same head of equities, same head of high net worth, and said, what did we learn? What are we going to do different? And their basic answer was that, well, that was a really horrible 2 years, but it's past us now. It's back to business as usual. And that, that was kind of the last straw for me. So I left Credit Suisse and I joined a buddy of mine who had started his own wealth management firm, and I moved my clients over there. And so that's what I'm still doing. I'm at a firm called Baker Avenue Asset Management, where I do my diversified wealth management business. Okay. And then in around 2011, I also set up Santiago Capital, which is the precious metal solution to the overall pie for the high net worth, diversified wealth management business.
So are you now a registered investment advisor?
Yes. Yes.
Okay.
Yes.
Okay.
Yes.
And all the models really shifted from commission-based business to asset-based business.
Sure.
To 2% or whatever it is. So I like your tagline: if you believe in math, buy gold. So you've seen quite a few cycles since 08 and 09. You've seen a bull market into 2011 or so. Wasn't at the peak at 1900, 2011. And now you've seen more of a trading range market, decline from 1900 to 1050. Let me ask you this: even though you believed in math, how did you handle gold giving it back and a cycle shift? Are you always bullish gold? It's a philosophy that you should have like 10% of your portfolio in gold-related assets, no matter what the trend is.
Yeah. So long story short, I wish I had handled this last 5 years better than I did. I thought we would have a V-shaped bottom. It turns out we've had a couple W-shaped bottoms, and and truth be told, I'm not sure if we're ready to come out of it yet or not. I think that regardless of where you think gold is in the cycle, things are bad enough, if that's the right way to say it, or situation right now with the with the global economy is bad enough, or however, whether you want to use bad or not, I don't know if that's the right word, but you should always have an allocation to gold in your portfolio, regardless of what the situation is, because you just never know. It's like an insurance policy against the rest of the portfolio, really. And I think that at a minimum, I think you should have 10%. At certain times, I think you could have much more than that. I don't think there's anything wrong with 15, 20, 25% of your portfolio, assuming that the rest of the portfolio is positioned in a way, that can provide you liquidity and, et cetera, et cetera, et cetera. I'm not somebody who thinks you should sell everything you own and put all your money in gold. I do think it's very important. I think it should be the cornerstone of your portfolio. I can't really think of any situation where nobody should own it, or that you shouldn't have any in your portfolio. But I do think at one point gold will get into a bull market. It will go up a lot, and there will come a time to sell your gold and go buy something else.
Okay, let me ask you this though. There are many ways to skin a cat. There are mining shares. You could own the bullion and have it parked somewhere else. You could hold it physically and put it in a coffee can and bury it in your backyard. Right. What do you espouse? I think that everyone should have it physical possession of some gold. And there are times when the miners underperform and outperform the price of bullion.
No, absolutely. So the way our precious metal strategy is set up is that we actually own the physical bullion. We own the bars. We have them stored in 3 locations around the world outside the banking system in private vaults. That's a little over half the portfolio. It's probably about 60% of the portfolio. It's always going to be at least 50%. Right now, it's closer to 60%. We also have the opportunity to invest in the mining stocks. We're not invested in any mining stocks right now.
Is that because a lot of them are kind of over leveraged and holding a lot of debt?
Well, that's part of it. You know, a lot of those they've done a really good job, I guess, I'd say in general over the last couple of years of cleaning up their balance sheets, cutting expenses to the as much as they can. And so I think when gold finally kind of breaks out of this, 5-year, 6-year bear market, that the mining stocks are going to be in better position than they have been, because they have done these cost cutting measures. But a lot of people get mad at me when my friends in the gold world get mad at me, and when I say that gold's not going to 2,000 this year, and I just don't know if we're ready yet. If we are, that's great, and I'll probably kick myself for not have bought some of these miners at the prices they are today. And
okay,
I think if you have a 5 or 10 year view, then and you don't mind the volatility, I think you can buy them now. But I think there's going to be another opportunity to buy them a little bit lower, so that's why we don't own them right now.
Okay, and before I ask you the difference between like juniors and seniors,
yeah.
I have a great question from Kareem. Why Santiago? Did you do the Pilgrim's Walk? How did you come up with the name of your fund?
I did do the Pilgrim's Walk. I walked 500 miles across northern Spain. Took me 26 days. And after that, I went and laid on a beach for a week.
Okay, all right. And is that the reason for naming it?
That's the key reason. So my 2 favorite books, the lead character's name is Santiago, and then I did the Pilgrimage of Santiago. So when it came time to picking a name, I thought that was pretty appropriate.
Okay. Any other precious metals that you at times consider, platinum, palladium, silver?
Yeah, silver.
You pay attention to the gold-silver ratio?
Yeah, so that, I don't know if you can see my screen or not, but I pulled up
well, you didn't have anything up there. I'm going to give you the screen back now. I just put up the gold chart, but
let me find, I've got
the screen back. So
give me a second here and
so share your screen again.
Let's see, where's this at? Here's the gold-silver ratio here going back, a long time.
I need to see your screen again.
Sorry. Okay.
There we go.
Okay. Now?
Yeah, I got it.
Okay. So this is the gold-silver ratio going back, 30 years, 40 years.
Yeah.
And you can see if you can see my cursor, I've got some lines drawn on here. But from 90 to 99, that was a great that was a bull market. The gold-silver ratio was declining. And you get into 2000 and to 2009, it's declining again. That's what you should see. You should see gold falling against silver in a bull market.
Silver should lead, and it hasn't been. It's been lagging dramatically.
Right, it's been lagging. You can see for the last 4 or 5 years, it's heading up, and it's last year there was this. I'll see if I can. There was kind of a key level here last year, where I thought it was going to, come down, hit here and come back down, and it kind of broke through it, and now it's moving up to the upside. I would have rather seen it, come down this way,
right?
To indicate that silver is now outperforming. Once we get into the bull market, I think silver and the miners will outperform bullion, and they were for a certain period last year, but that's kind of switched around here in the last couple of months, and you see silver and the miners both lagging gold.
Yeah,
I think silver's down for the year.
Excuse me?
I said I think silver is actually down for the year now. The miners are down for the year, and I think gold is flat, basically maybe up 0.5%.
Okay.
I mean, we're early in the year, 26 weeks in.
When we saw the crash or mini crash or whatever, the sell-off in equities, were you surprised, disappointed there weren't more flows into precious metals early in the week?
Not yet, because a lot of times, a lot of people don't realize this, but gold is a great hedge against these volatile periods, assuming that they last. But if it's just a 1 or 2 day volatility period, a lot of times what happens is gold gets sold because people get margin calls, and that's the most liquid thing, right? Or if you go back to 2008, gold went down, I think 15-20% before it ended up being up for the year, but there was a point during the year where it was down, I think 15 or 20%. And, you know, it was because when things were getting liquidated, you know, gold was one of the things getting liquidated because it's always liquid. There's nothing more liquid than gold. You know, I put out this presentation a couple of weeks ago, kind of middle of January, talking about some of the different markets. And I said, you know, the markets had come a long way. It was kind of breaking out, and that I wasn't sure we were going to. I said I would love a 10% pullback. I said I wasn't sure we were going to get it because I think for a number of reasons it's going to continue to go higher. But I would love if we got a 10% pullback. And I guess the moral of the story is if you say it, you better believe it because you just might get it. And you know, we haven't quite pulled back to this level, but it's pretty close.
Okay, so were you a buyer on that sell-off that we had into Tuesday? And I also wanted to ask you if you keep an eye, if you have a view on the dollar, since you're in, you know, involved in precious metals. The dollar.
So I actually have I have kind of a contrarian view of the dollar. Let me get to that in a second.
Okay.
Regarding the market, we were not buyers on, you know, earlier this week, but you know, we did buy some put options a couple of weeks ago on the S&P, which turned out to be a pretty good time, and we pulled those off earlier this week when the big sell-off came. So that was rather timely. We don't do a lot of that kind of stuff, but every now and then we will, and so that worked out pretty well. Regarding the dollar, I'm kind of I'll pull up a chart here of it. I'm kind of unique, I guess, in the gold world, in that I think the dollar and gold are going to rise together.
Okay, great. You know, I rarely hear that. So tell us how that can happen.
Okay, so there's a couple ways it can happen. And I put out a couple presentations over the last 2 years that kind of explain how it can happen. I'm happy to send them to you. Okay. You can watch them. You can send them to your listeners, whatever you want to do. But long story short, I think that, you know, in the same way that there's only so much gold out there and there's a lot of claims on gold, in a debt-based monetary system, it's kind of the same thing. There's only so many physical dollars out there. And if you get into a bank run, all these different claims are going for the limited number of physical dollars, and you can get a short squeeze on the dollar just the same way you can get a short squeeze on gold. Now, the difference between gold and dollars is that the government can print dollars, right? But they're not printing dollars right now. And I know a lot of people keep saying, you know, well, they're going to have to. They're going to have to go back to QE4 or QE5 or QE6 or whatever it is. And they might. I can't say for sure that they won't. But right now, they're not printing. And in fact, they're taking dollars out of the system. So they're decreasing the supply of dollars, but there's still an amazing amount of demand for the dollar. If you add up all the dollar debts in the world, and you figure and you assume that the average rate of interest on all the dollar debt in the world is the same rate as the average rate on the US Treasury, there's still $1.2 trillion a year of demand for dollars just to pay dollar interest rates, just to pay dollar interest coverage. And the reality is that, you know, it's not, all the debt in the world is not issued at the risk-free rate of 2.3%. It's probably double that. So there's probably $2.5 trillion a year in demand for dollars just to pay interest on dollar debt. So, you know, and the fact that the US government is not printing dollars right now means they're not supplying the market with the dollars that it needs. Because we're not importing as much oil as we used to, and we're not sending our dollars overseas, we're not giving the rest of the world that same flow of petrodollars that we used to. So we have a situation where I think demand for dollars is still incredibly high. Maybe it's not as high as it was 2 years or 3 years ago, but it's still incredibly high. But now supply is falling. And on top of all that, you have the US government coming out now and getting ready to issue more debt than they've ever issued before. And a lot of people will say, oh my God, they're going to issue another $1 trillion in debt. That's going to kill the dollar's going to zero. Well, in the long term, that's probably the case. But in the short term, if you have a limited number of dollars out there in the system, the Fed is not creating more dollars right now. And now you have the biggest buyer in the world, which is the US government, coming out and saying, we want dollars. We're issuing debt in order to get dollars. So they're basically buying dollars with their debt. You've got the biggest buyer in the world now entering the market where supply is already tight and they want more, and they want to compete with the rest of the market. That, to me, that's a setup for the dollar to go a lot higher.
That's really an interesting view from someone who professes precious metals. And,
Right.
they say we have so now most dollars are digital. Most dollars are digital.
That's
not
true.
Cash.
That's true.
And that's why a lot of people are hoarding cash, and that's why a lot of banks actually ask you questions when you go to the bank and say, well, I'd like to withdraw 5,000 cash.
Yeah, absolutely. Absolutely.
So
I think long term, it's pretty clear that long term governments like to debase their currency, and long term, the dollar will do like every other paper currency in history and go to zero. But right now, it's a relative world. China's still providing stimulus, Japan's still providing stimulus, the ECB still providing stimulus. We're really the only market out there that's tightening monetary supply. And a lot of people will say, well, they can't keep doing it. They're going to have to go back to QE. Well, that may be the case, but they're not going to go back to QE with the dollar, the DXY at 90, right? If the dollar fell 13% last year on its own, they don't need to go in and weaken it when it's fallen on its own. So
they're not going to go to QE with the S&P at 2,800 either.
Exactly.
Maybe at 1,500.
Right. And so if the pain gets bad enough, then they will print. But I think if the pain gets bad enough, the dollar's going to go through the roof as well. So, eventually the dollar will go down, but a strong dollar will just kill the monetary system. There's just too much dollar, and it will cause so many problems and cause so much chaos that I think the rising dollar will cause gold to rise with it in the chaos. So that's kind of, in a nutshell, that's kind of my theory.
Okay, so why don't we wrap it with the new wave? What's your take on crypto?
Wow, that's a great question. So, it's kind of I'm going to tell you a story here, and it's not an unemotional topic for me because somebody sent me the original white paper back in 2010. I read it in 2010, and I'm not a technology guy. I live near Silicon Valley, and I have a lot of friends that work in technology, but a lot of it goes right over my head. And I remember reading this paper, and I remember thinking, if this technology actually works the way that this paper says it works, in a million years, it'll never be legal because it's just way too powerful. And I remember thinking I should put, it was 25 cents at the time. I remember thinking I should buy $5,000 worth and just forget about it. And I didn't, because I was absolutely certain that the government would outlaw it because I thought it was too powerful. So I'm a big proponent of it. I think everybody should own some. I own a little bit. I don't own nearly as much as I should. And, had I bought that at 25 cents when I thought about it, we'd be calling you from
be a billion.
Branson's private island or something.
Right.
But I do think it's
be like Brock Pierce.
Say that again.
Be like Brock Pierce.
Yeah,
the
exactly.
Bitcoin billionaire.
Yeah. I mean, I do think digital coins are here to stay. Anytime you get this much money flowing into one area, you're going to get some bad actors in there as well.
Right.
And I think Bitcoin, as it's designed to be used, is not actually the way it's being used now. So I don't think Bitcoin itself is a Ponzi scheme or a bubble, but I think there's a lot of Ponzi actors and a lot of bad actors that are trying to use Bitcoin in nefarious ways. So you got to be very careful. But long term, I think Bitcoin is going to go higher. I think it'll probably be somewhat similar to the internet, where 90% of all these coins and ICOs and tokens and will end up going bankrupt.
Yeah, like the dot-com bubble.
Right. But there will be a handful that survive, and they'll go up a lot more than they are now. And I'd be very careful about how you do it.
What about your long-term belief that kept you out of it, that the government will not allow it?
Well, I mean,
change your mind?
And you can see some of this now. Some credit card companies are saying you can't buy Bitcoin with it. Some banks are not allowing you to do it. So, as it becomes more powerful, the government will react. And the interesting thing about it is they can make it illegal, but they can't really shut it down, right? Without shutting down the whole internet, they can't shut down the coins. But so, if a government, were to make it illegal, that doesn't mean you couldn't use it in Brazil or you couldn't use it in, China, and that government might attack it too, but on the black market, it could still be used. So I'm not telling you to go out.
What about eventually with the war on cash that a lot of governments, like, India did, called in notes that eventually that they let this experiment go on to get people familiar with it because they would like to have a digital currency to eliminate the underground economy.
I think that's a very legitimate view. That I could very well see that happening. I think there will always be, you know, whether it's legal or illegal, I think there will always be a free market option against the government option. You know, and maybe that free market option has to operate in the black market or behind the scenes or however you do it.
The dark web.
The dark web.
Yeah, I don't.
You know, but so I think there will always
dark
be.
web is when you know I get a blue screen.
Yeah,
but,
exactly.
But you know, Brent, what a great interview, man. You know,
well,
really.
Yeah, I appreciate you having me on.
Yeah, I never know what to expect, you know, and it was really a great surprise to, you know, your depth of knowledge of the markets and, you know, having a contrarian view that both the dollar and the gold can both be moving together for the same reason. And, you know, you're kind of a deflationary scenario is what you were describing. Like it or not, buddy, you're now my trading warrior brother.
Sounds good. Well, I appreciate you having me on.
Okay, Brent. So the best way for people to get a hold of you or follow you is at your Twitter handle at Santiago AU Fund, or you want to show do you have a website you'd like to show in the closing minute?
Let me just, you know, I due to legal reasons, I can't have a lot of information on my website, but if you just go to santiagocapital.com, you know, you've got there's my email, my phone number. Happy to talk to anybody or answer any questions or send any presentations that people are interested in.
See, the government saved you a lot of money. You didn't have to, you didn't have to put 50 grand into your website. So
exactly.
Again, thanks so much, Brent, and good hunting to you, and best of luck. And maybe we get together, you know, 3 months down the road and see how things are unfolding.
I'd love to do that.
Okay, Brent. Thanks you again for your edifying the F.A.C.E community. Everyone, that's a wrap for us. Thank you, everyone at investing.com for joining us today, and we'll wrap it up with TGIF tomorrow. Remember, don't just count your pips, count your blessings, and we'll see everyone tomorrow. Enjoy the rest of your day. See you in the private chat room. Adios.